So to go back into that, the idea here is to ultimately calculate the composite sales per unit. So you're using the sales mix, and you're going to be deciding that the sales mix ratio, what our selling price per cut is. So the idea here is 20 times 4. So we have the 20 times the 4 gives us our 80. The 32 times the 2 gives us our 64. The 16 times the 1 gives us our 16. So the total selling price for this composite unit, this combined unit, is $160. And then we're taking that $160 and we're figuring out a total variable cost for the composite unit. And so we take the variable cost, the 13 times the 4 equals 52, the 18 times the 2 equals 36, the 8 times the 1 equals 8. And so we're saying we sold all of these units, we had $160 in sales, we'd have $96 in costs. Our contribution margin per composite unit is 64. So if we sold all of these as one big bundle, it'd be $64. And so then we'd figure out the break-even point. We find the fixed cost per the contribution margin for composite unit. So we know $192 divided by 64 of this combined unit. We went over the $64 calculation, right? That was the difference here, 64. So again, it's the exact same formula, except now it's a composite unit instead of unit. And then if we take that 192,000 divided by 64, we get 3,000 composite units. I like calling them bundles. That's what you're going to hear more common in business. They're just called bundles. So we know what we need for this business to be profitable, to break even. They need to sell more than 3,000 bundles of 4 basic haircuts, 2 ultra, and 1 budget. And they might say, okay, we sell this on average in 1 hour. So they'd need to be open at least 3,000 hours in order to be able to break even. So that's one way to think of it. And then how many, we can calculate number of haircuts. We just take the sales mix and multiply it by the number of cuts. So 3,000 times the 4, 3,000 times the 2, 3,000 times the 1. We have the number of haircuts we need to do in order to make our break-even point. And so this is just showing you ways, right? We can get a very simple set of data. This is all we received right here. Here's what we expect to sell. Here's the selling price, the variable cost. We can calculate the unit contribution. And from this, we are able to figure out how many haircuts we need to forecast for, how many hours we might need people to be working, how many hours we might need to be open. It lets us forecast. And that's eventually what we're going to get into in some of the future presentations, is budgeting and forecasting, using all of this information to then, how do I decide over the next 3 months, how many people do I need to hire? How many places do I need to rent? How many materials do I need to buy? And then we can figure out contribution margin based on each unit, basic, ultra, budget, and then the total contribution margin we expect minus fixed costs. And then for a break-even analysis, our income is always going to be 0. Assumptions and cost volume, profit analysis. All this is saying is what I've said since the beginning of this presentation. These are all assumptions, right? We're classifying costs as variable or fixed. Remember, there's other types of costs like step, the multi-curve. Costs are linear within a relevant range. That relevant range means we can only have to do it in one warehouse. If we go outside the relevant range, we need a second warehouse or third warehouse or second employee, third employee. And we're assuming that the costs are linear. The fixed cost is static, and that our variable cost is a linear cost with a straight slope. That's not always the case, right? Leases might have contingent features in them that make cost change. So we're making these oversimplified, but it's good for education purposes. All units produced are sold, right? That's not always the case. A lot of times when we produce units, we can't sell them, or we have time that isn't utilized. We don't bill for all the time that we spend. And then our sales mix is constant. That's not always the case, right? So maybe 1 month we have only sell budget haircuts. The next month everyone wants an ultra. So a lot of assumptions have to be made, and then we revise those assumptions over time. And so that's part of running the business, is making sure that we're actively engaging with those assumptions and revising them to be more accurate. And then lastly, we're going to be talking about ways we can analyze these sales. And these are just going to be a variety of metrics that I want to be explaining, which is just the degree of operating leverage. And so I want you to memorize these formulas because anything like the high-low method, scatter plot, degree of operating leverage, you're going to be tested on this stuff in all your future finance and accounting courses, and eventually in the CPA exam if you become an accountant, or CPA. So make sure you just know these formulas. The earlier you memorize them, the better. But operating leverage is the extent to which fixed costs are being used in an organization. And we can measure how a percentage change in sales will affect profits. So the total contribution margin in dollars divided by pre-tax income tells us our operating leverage. And what that helps us with is it tells us that with a 10% change in income, what we'll need, if we want a 10% increase in sales, our income will increase by 30%. So our change in income in percent is equal to our degrees, our operating leverage times our change in sales. And so that's really helpful, right? That if we increase our sales by 10%, we actually get a 30% increase in income, so a higher operating leverage is better. That means that our sales greatly increase our income, which means that we're not having a lot of fixed costs, right? Our total contribution margin isn't hitting our fixed costs too hard. We have a high contribution margin compared to our fixed costs. So just another way to measure our business and compare to other businesses. So we could look at multiple departments in our business and determine, for accountants, they might say we have a tax arm and an audit arm and a consulting arm. And they might decide, well, the consulting arm has a higher operating leverage, so we should invest more into them, because for every dollar that of contribution they make, it winds up being more of income for us, right? While if we had a lower, let's say this was lower, let's say an audit is normally a low operating leverage kind of business, and it was 1-for-1. If we make more contribution margin in audit, our change in income might only be 10%. It might be a 1-for-1 match, or maybe even less. And so we want more operating leverage. So I want you to memorize this formula. It's going to be very helpful for you. Just different ways, not just from a memorization standpoint, but it helps you think about business differently, about how to compare your opportunities for employment, your opportunities or your employer. And then lastly, we have some appendixes on doing using Excel for cost estimation. I kind of went over using Excel a little in Google Sheets. We're not going to expect any Excel calculations other than that, so we're going to skip over that. And then there's this concept of variable costing versus absorption costing. Just know absorption costing is a gap. That's that using inventory. That's all that means. They're synonymous. So absorption costing just means gap. It means that we're using the concept of inventory, capitalizing cost of sales into inventory, while variable costing is that contribution margin, where we're taking fixed our sales minus our variable cost equals contribution margin minus fixed cost equals income. And so just know that the two are different. One's required for GAAP, one's required for, not required, but used for internal reporting. And so just know contribution margin is known as variable costing. Variable costing, we went over that all today. That includes direct labor, direct materials, and variable overhead. And fixed overhead costs are excluded from the product cost and go into our fixed costs in the contribution margin, while GAAP requires that fixed costs be put into our direct materials, direct labor, and our overhead, right? GAAP requires that we capitalize any inventory costs. And so that's the big difference there, and which makes it GAAP less reliable for internal reporting if we're just looking from a break-even standpoint. So that's it. I'm going to open up for questions. Any questions so far? I'll pause the recording.